So you are welcome one more time, and this time around we are looking at acquisition and merger. Acquisition and merger. Now this part has 4 aspects of it. Actually, it has just 2 aspects. So the first part is your theory. You need to read the theory, all right, and you need to understand the concepts, all right, over there. The second part is where we actually go into the calculative side, right? So we do the calculation, and under the calculation is just categorized into 3 perspectives. You have one where you have to find the NPV of an acquisition. Then 2, we want to know what we call the minimum amount acceptable by the target company, the company that is being acquired. So minimum amount acceptable and the maximum amount payable. All right, or the maximum amount. So the acceptable is by the target, the maximum amount payable by the parent or the predator, the one who is going to buy someone. How much should they buy? I mean, how much should they pay for what they are buying? The limit to which they should pay, not can, but should. All right. Then the last one is the acceptance or rejection decision. So we are looking at post-acquisition evaluation. After buying it, we want to see what will come out of the company. Is it a good decision? Is it a bad decision? So where you accept or reject the acquisition. All right. So these are the overall aspects. So let's start with the theoretical part. So let's do the theory. With the theory, we need to go through and do some readings. And this is where I ran over, but you have to get the manual and read. All right. So we have acquisition and merger. It's a means of growth. All right. So you acquire another business. Normally, people acquire another business to have a huge market share and huge profitability prospect. All right. So, but there's a difference between a merger. All right. So you need to understand that merger is coming together of 2 or more entities that are approximately of an equal size. All right. And they come up with new identity. Right. So you merge, you come out with new identity. Right. You don't, it's like 2 people coming together and when they come together, let's say A Limited, B Limited, when they come together, they have a whole different name together, right? So that is that. So I have here Pearson Spectre merges with Derby, all right, and they call it Pearson Derby, all right, Spectre. Those of you who have watched the movie of Suits will understand this kind of merger, all right. So that is that. And then we have acquisition, whereby one is taking over the other. All right. So there's a bigger entity, then there is a smaller entity that has been acquired. That is what you did in your FR and consolidation. All right. So basically, that is that. Then why do people merge or why do people take over other entities? Most of the time is for the sole purpose is to increase the shareholders' wealth maximization. All right. So anything that you would do to come up with that, that is the reason why, because people want huge market share. Why do they want the market share? Just to increase the shareholder wealth. Don't forget that is the underlying assumption of financial management. All right. So that is that. Now we have type of merger and acquisition. You need to understand that. So we talked about we have 3 types. So the types, we have the horizontal, then we also have the vertical, Then we have the conglomerates. All right, so these are the types. All right, sometimes it comes in your exams for you to express your understanding about it. But let's look at the horizontal. You see, the line horizontal looks like this. All right, and the line vertical looks like this. All right, so what is horizontal? Horizontal simply means that you are acquiring or you are merging with an entity who is on the same production line, the supply chain with you. They are on the same supply chain with you. Okay, so the same, they are closely related, same business line, same industry, same distribution chain. All right, so that is that. So what kind of example can we have? You are the same level. So let's say a TV stations, one TV station acquire another TV station. All right, it's a typical example of that. So you see that they broaden their market. Let's say Pepsodent acquires Close-Up or merges with Close-Up. They are in the same production line. They are closely related. They are in the same industry. They are in the same business line. They come together. So when that happens, what you see is that their market share goes up. All right, and competition is eliminated because they used to compete. Now they are together, all right? And it will help them to improve their product mix. I mean, come out with different types of products, all right? Mixture of products, and also increase the economic of scales. Increase in economies of scale simply means a reduction in your cost per unit because of an increase in the volume, all right? So basically that is that. All right. So when people do that, the authorities must take notice because they can exploit the market because they have large market share. Then they start doing those kind of monopolistic activities. Then let's talk about vertical. Vertical, they are in the same industry, but they are in a different line in the supply chain. So one may be, let's say this is a wholesaler. This is a, let's say, manufacturer. This is a wholesaler, this is a retailer. You see, they are different in terms of their positioning in the market, but they are in the same industry, all right? So what happens? What happens is that you acquire those when somebody here acquires a manufacturer, then it means that you want to stop the delays in getting his supplies because now he will manufacture everything himself rather than depending on the manufacturer to bring the things to him. This one to the distribution, the retail distribution, he will control it, all right? So you control your supply source and also control your distribution source. So that is the kind of measure that happens. Now, because of that, because it can be here and it can be here, what happens is that we have two types of that too. All right, so we see here that you want to control your means of production and distribution and also certainty in the supply and demand. All right, so that is that. It can be backward, it can be forward. So you can say upward and downward, but that is it. Here we are saying that this type is backward. You are going back to the supply source. All right, then this side is the forward. It means you are controlling the distribution plans or the distribution points. All right, so that is that. Then we have the conglomerate. Conglomerate simply means that you are in a different industry altogether, but you are coming together. All right. So that one, the purpose is to diversify because of systematic risk. Of course, you've learned that in the work. So because of systematic risk, you want to avoid as much as the systematic risk you can. Then you have to, I remember when I was in the university, my lecturer used to say nonsense correlation. So what correlation does a maze have with a car? Kind of an umbrella with a maze on, that kind of thing. But you diversify because if there's a risk in one industry, you dodge it. So you don't put all your money, let's say, in the financial market, all right? But you put your money in different sources. And so when that happens, you realize that you are protecting yourself from some sort of risk, all right? So people do that to bring about risk reduction via diversification and also cost reduction and improve brands because the more they diversify, the more the brand is also going out. All right, so that is that. Sometimes People do acquisition and merger for economic reason. That is the market reasons. We stopped speaking about that. All those things, economic share, market power, and all those things. Then we have the financial decision. People come together because of tax, strip people of their assets, and also reduce the risk. All right. So take a look at these things. Advantages of acquisition and merger in terms of what is the advantage of doing an organic growth, starting from the bottom as compared to acquiring. We did this thing in our first ever meeting, you remember? Yeah, so go back there and you revise it. Because organic growth is less risky, but it is costly. By the time you save money to buy a car, the price have gone up. You save to top up, it has gone up again. So basically, those are the issues there. The disadvantage is that organic growth is slow and, like I said, it's expensive. All right. Sometimes it becomes impossible. All right. That is that. And acquisition is quicker, but it's risky. But sometimes the entity that you are going to buy, you have to be careful because if you don't do your due diligence, well, you may buy their liability too. All right. So that is that. I mean, and say you are working in the company, you know you are going to be acquired as a staff. All of a sudden, you start thinking, am I going to be sacked? That kind of thing. All right. So integration problems, and take a look at why mergers and acquisition fail. They fail because of preemptive theories. People want to buy the thing before it is even due, before they are ready. So they do that. People also window dress their books because they are going to be acquired, and sometimes the inability to manage the change. It's possible. Sometimes cultural issues also come in. Errors in valuing the target, lack of goal congruence, agency problems. I mean, we discussed all these things in our very first meeting. Now, if you are going to acquire somebody, there is kind of a corporate aspect to it and a competitive aspect to it. As for the competitive aspect, we can talk about the Porter's five food theory. All right. So we talk about the market power. You have market share. Again, you want to prevent people from coming in. You want to have economies of scale and economies of scope. Economies of scope is product mix, all right? So that is that. But corporate-wise, you want to do branding. You want to actually have the issues there is that when you want to also expand, you get people having a hostile movement against you. We don't want you to, we don't want this, we don't want this acquisition, we don't want that. I mean, that is that. Integrating the company systems and operations is a whole issue that you need to think of. Then we have, if you want to identify entities to acquire them, strategic texts are available to you. You can approach the possible entity to acquire, looking at the organization itself, their sales and marketing, their technology. Think of tax information, think of treasury information. Now, when you see that, then you can select the best acquisition target. Then you decide how you are going to pay financially. Basically, that is that. Tactically, you look at companies when they are struggling, and you pounce, all right? You go in there. Now, when in this discussion of acquisition and merger, one of the key things that people want to acquire another or merge another entity is this word, synergy. Why do people marry? Why do people merge together? Because you can't do it on your own, all right? So when you are a single person, you marry another single person, but you can give birth, and for all of a sudden, your power is 3. So 1 + 1 is equal to 3. It's a concept of synergy, all right? Not 2, 3, because when you come together, you give birth, you multiply. So that is that. So what is synergy? Synergy is the benefit you get when you are together, all right? And those benefits, you never get them if you are not together. So that is what we call synergy, all right? So there are so many forms of synergy. So we see the value of A and B combined when they are greater than the value of A and B individually. You see, this is individually, they are one. This one, two is one. But when they come together, they are three. That is what we mean by synergy. All right. So that is that. The exponential increase that you will not get when you are independent. All right. So that is that. And the synergy can be in the form of revenue synergy because you come together, your revenue increases. All right. It can also be in a cost synergy that because you came together, your cost has fallen. All right. And through synergies too, you can eliminate double roles and also increase inefficiency. But sometimes when you come together too, your costs too can go up. It's part of additional cost. It's a negating synergy. As you came together, it's all about fights. It's a negating synergy, but positive synergy is when things go well after your combination. All right. So basically, that is that financial synergy. All right. All the better things you get as increase in your financials because of that. Okay. So that is that. And when people are going to merge, you see, to the person going to acquire somebody, he sees synergy. So the acquiring company is seeing synergy. But the person who is being acquired is seeing money that he has received, premium on top of his value. All right, so that is that. And the debt holders too, depending on the contract, they know how to do. But for staff, some of them fear redundancy, especially those in the target company. But some of them also see an opportunity for growth. All right, especially those in the predating company. For the society, we are just afraid of manipulation because president close up, come together, then it means that you need to be careful. Or yes, or which other ones? Colgate. I mean, it means we must stand well. So people may have a strategic defenses against acquisition and merger. So people may try to avoid the acquisition and merger. And this can happen after you have received a bid or before you receive the bid. So when somebody brings up a bid that he wants to acquire you, what are some of the things you can do to prevent the acquisition? He has already brought the bid. The only thing you can do is to convince your shareholders not to accept it. Prove to them that if they don't accept it, your company is going to be doing well, as opposed to if they don't, you are going to fall down. So that is that. Again, you can lobby the office and see that if there is, of course, SEC, stock exchange market, all right, you can go to that, go to them and tell them that this acquisition, you see some kind of illegalities in there and let them know. Or you can just do these things so that they place injunction. Some people played court injunction on some form of acquisitions just to slow it down so that you buy time to prevent it completely. All right. You can also launch an advertisement campaign against the takeover that, hey, if they come together, society, they are going to practice monopoly. It's like the way the politicians do. They know that sometimes some of the things they are saying is not true, but I mean, I just don't understand. People willfully will lie just to get a position. But they are saying, don't vote for this guy because he said this, you want to do this, he said that, and all those things. So the person has already ticketed, he's standing for an election. Not when he's about to, he has already done that. And so people will start throwing tantrums and negativity and what do they call that thing? They have a term for that thing, propaganda. Yes, all those things. All right. Okay. There is also a way that you can do a reverse takeover. That as the person has put in a bid to take you over, you put in a bid to that same person who wants to take somebody over. That kind of thing. So, I mean, I want to buy you, you want to buy, like that kind of competition, just to prevent the acquisition from happening. Or you can find a white knight. This time around, you are not the person doing the reverse bidding. You will find a friend who is bigger than you to also bid for your company. All right. So get the difference right. Packmark, which is a reverse takeover. The Packmark is a reverse takeover. That one, this is the predator coming to take over a target. Then the target who wants to prevent the takeover also make a move on this one. All right. So a reverse takeover. All right. So that is that. Okay. Then we have the white knight. So the white knight, as a predator wants to take over a target, the target will find a friend, you to come and bid. So if this guy bid 5,000, you bid 6,000. So we will give it to you, but we all know that you are just standing in as a white knight. All right. You are not really coming to purchase it, so that you just prevented this guy from purchasing them. All right. Then we have crown jewels. What is a crown jewel? A crown jewel is basically the beauty part of a company. All right. So the beauty part of a company. So if you look at those crown jewels, then you can, I mean, we deal with that mainly on the pre-bid. All right. So what you are doing is that you need the approval of the shareholders in a general meeting. So what you are going to do is, we call it a Scotch F kind of thing. So it means that you are having a crown jewel policy whereby you make certain aspects of the company that the target become untouchable. That before you can do that, you need the approval in a general meeting. And we all know a general meeting takes a very long time. So we have to wait for that. Yeah, that kind of thing, just to delay it and find a way to prevent it. Then we have the pre-bid. Pre-bid, if you know that you are going to be taking over, then you sell your crown jewels, the beautiful part of the entity. When you sell that part, you become unattractive. So the person who wanted to buy you because of your asset, probably they are gone. So why will he come to you? We have the golden parachute. Yeah, so it says that it's a policy of introducing attractive termination packages for the senior executive. So we parachute as if you are going to purchase us, then it means that we are going to leave. And as we are going to leave, there is a huge payment you have to be making to us. So will you buy us? All right. So that is that. Then we have the shock or the shock repellent. All right. So here we are looking at some articles of association or memorandums of understanding that you put in there, all right, in your company. So it means that, yeah, it says that the article of association are changed to require a very high percentage of shares for us to approve of an acquisition and a merger. So it means that we need a majority of people to approve of it. If they don't, then it won't happen. So not a simple majority, a major majority kind of thing. All right. So then we have poison pills. So poison pill is also a situation that, I mean, we commonly use to also defend against some kind of acquisition. So let's just say that you are going to be acquired, and at the time that you want to be acquired, we do a diluted earnings per share, and the shares of people increase. Or let's say by the time you want to buy us, we just go in there and borrow. So if you acquire us, you are buying debt. So those are kind of things that people do just to prevent it. All right. You take in something better. All right. So you dilute the ownership, all right, of the potential acquirer. So there are regulations. I mean, you need to seek advice. You need to make sure that the acquisition is done ethically. All right. So these are most important. Now, let's come to the calculative aspect of it. Then the first part I want us to look at is how to do the NPV of an acquisition. NPV of an acquisition. Now, in the NPV of an acquisition, the NPV of an acquisition is equal to, now, what do you need? What we need here is the what do we call it? The synergy. So we call the gain minus the cost. So this is how we find the NPV. Now, the gain is the synergy. The synergy. What is the synergy? The benefits for coming together. All right. And like we said, synergy is if the entities are A and B together minus A standing alone plus B standing alone. All right. So basically that is that. That is what we call synergy. Now, what is a cost? What is a cost? The actual meaning of the cost is premium, not necessarily purchase consideration. It's premium. All right. In corporate reporting or FR, we call it goodwill. It means what you are paying over and above the value of something. Something, the one that we call profit. So the cost here is what you are paying on top of the thing's actual value. And that is why, in your FR, you do purchase consideration minus fair value of net asset at acquisition. Yeah. What is net asset? That's the equity company's value you are buying. Don't forget, you've done this thing in business valuation. So premium, the cost is the premium, what you are paying over and above the value. So it means that the cost, we will need the purchase consideration. The purchase consideration. Minus what? The value of a business. Value of the business. And we've done valuation of a business. That is why the examiner loves acquisition and merger, because in it is a valuation, a business valuation. All right. So this aspect of your exams is usually examined a lot. All right. Now, the purchase consideration, there are so many types of purchase consideration. You remember in your FR class, there is a cash one, cash, where you go in there and pay cash. So here, cash consideration, you go there, you just pay cash. There are advantages and disadvantages, and these ones, the book helps you a lot. Because when you are paying cash, what is happening is that the target company who is collecting the cash will improve of his liquidity. That is that. So you see that the money is readily available. So you see that they collect the money physically. All right. So to the target company, he is collecting cash for his liquidity. Now, but the disadvantages of receiving the cash also is that when you are taking the cash, what happens is this. So you see, as stated here, we say disadvantage of receiving the cash is that if the price that they receive is on the sale is more than the price paid when purchasing the shares, they may be liable to capital gain tax. All right, so that is that. But to the predator, the fact that he is paying cash, it means that he is not using his own shares. All right. So he's not using his own shares. And so it makes it quicker. So he pays the thing off very quickly. And therefore, there is no participation of control. It's not shares. All right. But again, so he says that the main disadvantage to the predator is that it will deplete his liquidity because your cash is going out. All right. Then again, of course, you have methods of raising cash. You can go to the bank to borrow. You can use mezzanine finance. All right. Okay. So retain earnings, vendor placement. But again, you can also use share for share exchange. Those of you who have done financial reporting, you know what I'm talking about. Share for share exchange. So this one, the thing is that when you give the target company a share into you, the parent company's company, into your own ownership, it means that they have control, a certain level of ownership into your business as well. So basically, that is that. All right. So that is that. Because of share price movement. Okay, so you have to take note of that. Now, what will be the advantages of the share for share? What will be the disadvantages of the share for share? The disadvantage mainly is that they are also coming into your business, so there will be dilution. But of course, there is no cash payment, so your liquidity is intact. All right, so basically that is that. So take a look at the advantages and the disadvantages, which are examinable. Basis the reason I ask you to place your order for this financial reporting management. That will help. All right. So that is that. Of course, there can even be loan notes. There can also be what we call earn out, where you pay some money small, then the remaining you pay it when you are making profit as you are together. Call it earn out. All right. Each one of them has its advantages and disadvantages. All right. So this is how we calculate the NPV. All right. So that is the first one. Keep it in mind. because we will take some illustrations and do, but I want to, okay, so let's go and pick an illustration on that and first capture that. So, okay, so look at this question. Look at this question. So if you are asked to calculate it says that this is the information of entity A and B. The market price is there for all of them. If A intends to pay 1.2 for B, what is the cost premium? So here you are asked to do the cost premium. So how do we find cost premium? This one, cost premium, is the value you are paying minus the value of the business you are going to pay the money to. We are buying B. What is the value of B? Market price is here. Number of share is here. The value is here. But so we are paying 1.2. So 1.2 million minus 0.9 million. Clearly, this is 0.3 million, and that is your cost premium. That is that. So they are saying that do it again if B shares includes a speculation element of 2 cedis. If it includes a speculative element of 2 cedis, then we must take it out. So it means that it's 30. So it means they intentionally increase the price because you are coming to buy them. But no way, take it out. You have 60,000 multiplying 13. And that is 780. If I now take my 1.2 minus that, it means I have the value of the business to be like, what I have here is 420. So like you see here, all right, that is their worth. When you work it, you have 420. So basically, that is that. All right, so that is how you do it. So if you are at the NPV, then you do the rest. I just want to see the questions that probably there are past questions that you might see something. Definitely we will get some. So just keep the formulas in mind. And when we start the past questions, you'll see them. So that is the first part of the calculation. The second part of the calculation is calculating the maximum amount you should pay and the minimum amount that is acceptable. And that you will find it here. All right, so that is that. Now, what is the maximum amount you should pay? First of all, let's talk about the minimum amount acceptable by the target. How much should they accept? How much they should accept is their value, nothing below their value. So how much they should accept is equal to the value of the target. That's how much they should accept. But how much, the maximum that amount Predator should pay. How much should they pay? How much they should pay is the combination minus themselves. So when they come together, so let's say A and B coming together minus only A himself, where A is the Predator. So when we come together and I take out myself, so the value of the combined minus the value of the parent is the maximum to pay. A quick example here. For example, it says that ABC is considering to make a bid for XYZ for a firm whose PE ratio is 9 and its earning is what? 390. So it means that XYZ has a value. And what is the value? Here, it means you are going to do business valuation. And the information given to you, it means you are going to use the PE ratio. P ratio is what? The P ratio multiplied by the earnings. So XYZ is 9 multiplied by 390. So what will we get? 9 by 390. Don't forget, this is, we've done that in business valuation. So this is its value. That is its value. Then, of course, standing alone, that is its value. And ABC, who is going to acquire somebody, also his value is 13 multiplied by his is earnings of this. So what is its value? 13 multiplied by 693. Its value too is 9,009 million. So that is their value. And the question said that, so if you want to calculate the minimum value acceptable by XYZ, this is it, this value. That's all. Use any of the business valuation formulas with the information given you to do that part. Then, what is the maximum amount which ABC should consider paying? We said that the combined minus the ABC himself. So what is the combined? The combined is that we are told that it is thought that 125 of annual synergistic savings will happen if they come together, and the P ratio of the combined two is 12. So if they come together, we have earnings of 390 and this one two of 693, plus there will be synergy of 125. So that makes how much? 390 plus 693 plus 125. That is 1208. Multiplying a P ratio of 12, that is 14,496. That's the combined. So if how much maximum they should pay is the combined, which is this minus he himself, him, the ABC himself. So minus 9,009. The maximum amount they should pay for this guy is 5,487 million. So something. So basically that is that. All right. That is all. Then the last part of the calculative aspect. So you see this, these are your answers. All right. I think there is even a typical example also here for us to do. We will come back to the past question, but it looks as if, so what is the requirement? You are supposed to explain all these things and determine whether it will benefit powers if they come together. Okay, so we will look at those type of questions. So let's look at the last type of the calculative aspect. That is the post-acquisition acceptance or rejection. So this is it. So calculating the total value of a company after acquisition, all right, to determine whether you should accept or reject. All right, so how do we do that? First, have to bring the value of the company together. So individually, you value each one independently, then you add the gains that will happen when they come together. All right, so you just add the gain that will come when they happen. So just like we did the combine, right, in the example we did now. So you put them together. Then you do the share for share exchange, all right? So you calculate the number. So we talked about the NPVs part already. So here you do the percentages of all the additions of the shares, the parent own plus the right issue they will do to increase the number of shares. When you have that, then you calculate the new share price, all right? So basically that is that, you calculate the new share price. All right. So better explaining this, let's use the illustration here. So this is what we have. It says that the company A has 200 million shares, which is trading at 4 cedis. So what will be the value of that company itself? That is 800,000 or 800 million. That is what you have. And the company B has 90 million shares, also trading at 2, meaning that their value is 180, right? Million. Now, it says that A makes an offer of 3 new shares for every 5 held in B, and A has worked out a present value of a synergy. Very good. Synergy always has to be a present value. Always has to be a present value. All right. So PV of synergy That is the gain. So when they come together, they will have a synergistic improvement of 40 million. So that is that. So it means plus 180 plus 40. Their value together will be 1020 million. That is their value together. But what about the shares? Predator shares, as we already know, they have 2 million shares. And they said that A makes an offer for 3 new shares for every 5 currently held in B. Now, B has 90 shares. So, right issue is that it says that for every 5 that they have in there, they are going to receive 3 new shares. What would that be? 90 over 5 multiplied by 3. That gives him 54 million shares. So it means the total number of shares now, when they come together, is 254 million shares. Therefore, what is the value per share when they come together? Market value, market price per share when they come together. That will be 1,020 over 254 shares. 1020 divided by 254. That means their new share price is going to be 4.02. So that is now. So what you do is that you have calculated the expected share price of the combined, and you have to advise whether the shareholders in company B whether they should accept or reject. Now, how do we do that? We do that in a presented nicely table. So we have company A, right? And so what you do is that there are number of shares. So let me show you the table just here. So this is it. Their shares, all right. Their value, market value now. So new market value, and their old market value. Then you do the change. So what do we mean by this? Before, what did you see for A, company A? So now company A already has 2 million shares, according to the question. Now, their value of each share is 4.02. So as you come together, it is 4.02. They also have in B 54 shares, so million shares, and that one too will be priced at 4.02. So that is it. Now, if you are determining the new market value, 200 multiplied by 4.02, that gives this one 804. Then 54 by 4.02, that gives this one 217.08. But individually, when they were not combined, this one was 800,000. And the second one, 800, and the second one was 180. So if you look at this, to this guy, when they come together, A will have a positive improvement of 4 because now its value is 804, but before it was 800. This one, what will happen? 180. What will happen is that he will also see a major boost of 37.08. So it means in this case, company B should accept the acquisition and merger. Company A is already happy, so company B is also seeing a happy. So basically that is that. So if you strike the difference, first you were 180, now you are 27. So if you do the 37 over their past 180, what you see is that he's having a growth of 20.6 or 21% just because he has acquired. So they should accept the share for shares. Basically, that is that. So these are the 3 areas of the calculations. Either you are doing an MPV or you are doing maximum amount payable, minimum amount acceptable, or this kind of things. All right. So what we need to do is to try and deal with more questions. All right. We've dealt with this one. And so we have this one to deal with. Okay. So look at this one. And this thing appears in your exams almost a lot of times. Mavis and Powers Company are listed on the stock exchange, and you see that their share price today These are their share prices, and these are the shares they have in issue. Meva wants to make an acquisition of 100% of Power, and the company is considering 2 new shares for every one in Power. Evaluate if the 2 new shares is will succeed, and if possible, recommend the revise. All right. If it will not succeed, then you give your own way of it. Now let's work it. What do we need? The total value of the company when they come together. All right. Is there a synergy in this? No. So it means that if their share price is this and they both have this market prices, then it means you have Mavis company whose value is 3.05 multiplying 48 million shares. So that is that. What is the value? 3.05 by 48. That is 146.4. What about Power? So it's 6.08 or 6.8 rather, multiplying 13 million. So 6.8 by 13, that gives 88.4 million. There's no synergy, so you can say synergy is 0. So it means the combined entity has, so plus 146.4. The combined entity is 234.8 million. What about their shares? Already, Mavis is the one going to buy. So Mavis company has how many shares? 48 million shares. And so in terms of Power, what is going to happen is that they are buying everything. And it says that, so 48 million shares. It says that the directors are considering 2 new shares in Mavis company for every one acquired. So Power has 30 million shares, right? 30 million shares. For every one acquired, he's going to give 2, which means that here is going to be like 26 million shares. So that makes it here will be 4, right? And here will be 7, that's 74 million shares. So what is the price per share now? So 234.8 over 74 million shares. So my answer is 74, right? That gives me 3.17 cedis per share. So now let's do the analysis. So we have the shares, we have the new market value compared to the old, then we see our change. So if we take Mavis, Mavis had 48 million shares, which is priced at the new value is 3.17. So by 48, this one gives me 152 million.3. All right. So, but before, what was their value? 146.4. 146.4. So what is the change? 146.4. The change is 5.90, which is for him, it's okay. But what about the other party, which is Power? For Power, is going to be 26. So 26 million shares at the price of 3.17. So 26 at the price of 3.17. That gives him 82.42. But before, what was their price? 88.4. So clearly, they are going to lose. And so they may opt to reject it. So 5.98. They may opt to reject it. So that is that. So it won't succeed, basically. They are not going to succeed. So that is what you see here. So what is going to happen is that they are going to reject it, basically. So That is it. So it means that the share for share exchange, that is what do we call it? The 2:1. Giving 2 shares for everyone will not make it work for them. All right. So what should they do? So this is the presentation of the table. I think that you see it is a plus here, here is a minus that you see. That's what you see. All right. So the advice is that they will not accept it because you see that it will end up with them having a negative. So when that happens, then you are going to propose a new share, the one you think it will work for them. Is that okay? So how do you do that? Is to take this old value. All right, so you take the predator's value, which is 88.4, then you divide it by the old share price of this is the target. You divide it by the old share price of this. So it's called offer price over predator price. So this is the predator. So you can do this, take this one and divide it by, or you can even use these figures, but you can take this one. This is the value of the company divided by 0.3 predator price, 3.05, sorry. Then it will give you some shares. So 88 over 0.4 over 3.05. It gives me something like 28.98. All right. So when you take this value, 28.98, you run it. So what will be you use this, the number of shares here to determine a fair exchange. So what I have here and what they had was 13, right? So if you say 28.98 divided by that 13 million, what I get is 2.23. So it means if you want to offer a share, it must be this one is to this, okay? So, and that is 2.23:1. So you have to give 2.3 shares for everyone acquired. So that is that. So that is all. So all you need to do is to take the target value and divide it over the predator. So you get the number of shares. So in terms of relative to their shares, you just divide it by this, and that gives you the ratio. Because shares are not in points, so you can say, let's say 3:1 or 2.5:1, or let's say 3:1. Because already they are doing 2:1. So the one that would be preferable would be 3:1. All right, so that is that. You don't need to really rework it, but you can rework it. You see that it will work perfectly if you want to rework it. All right, so that is that. All right, so we have other questions to deal with. Very simple. This has already appeared in the exam. That's why I encourage you to buy the book. You'll always be getting some form of questions in the book. It says that Laguna and Venice is a listed company considering takeover bid. All right, Laguna is considering takeover bid for Venice using a share for share exchange. And the requirement here says that advise Laguna a suitable share for share exchange. All right, so we need to work it and find out if it will work. If it will not work, we will do what we just did to do it. So it says that if the acquisition go ahead, synergy of total of 20 million are expected to be achieved. Venice have indicated that they will be happy to accept the offer that enable them to achieve a premium, 25% premium the acquisition. So for them, that is that. So if they don't meet a 25% of their own value, they will not accept it. They will not accept it. The premium is what you pay on top. But what is Venice's value? So Venice, their value is 8 cedis multiplied by 5 million. So what is that? 8,540, right? So like 40 million. So they want you to give them something that at the end of the day, you have to give them something. So this 40 multiplied by 1.25 is what they will accept. They want something 25%. So 40 by 1.25. So that's like they want something like you give their value should be 50 million. Anything below 50 million, that means that they are not willing to accept, all right, after the acquisition. So take note of that, all right. So, and we take Laguna, whose value is 10 multiplied by 10 million, and that is 10 by 10 is 100. So basically, this is it. We were taught of synergy, right? They told us that synergy is 20. Synergy is 20. All right. So if synergy is 20, we add everything up in here. So this one, they are saying that they will only accept it if you pay their value is 50. That is basically what they are saying. You too, when you are going to pay the money, it means that you need to pay a premium of 25% of it. So basically, that is what they are trying to say. So if the premium, which means that the premium is 10. So it means that for what they want to see is that you have their value at the end of everything should be. Now, the question said we should determine a suitable exchange. The suitable exchange is always given by offer price. So, and comparing it to the predator price. Basically, that is how these things are worked with. So that is how you find the share for share. So like the way we went around it in the first example. It's easy by you saying that you can actually decide to say that, okay, so here they said that determine the suitable share for share exchange for the two, the share for share exchange. It's easy for you to say that if this guy is paying 10% more, then it means that at the end of the day, you see, it's a suitable share for share exchange offer, giving himself out with a 10 versus the 50. When you do the division, you have something like 2.2 shares is to 1. That is a perfect thing because if so this 2.2 is basically saying 1 over 110 over 50. So you get 2.2. 2.2 is to 1. That is fairly easy. And it is true because if they are not 50, they won't do the share for share. So you use their value to be kind of a 50. So here, offer price, it means that, so when we talk of offer price, it means how much these people are willing to accept. And what they said they want something beyond what 50. Beyond 40, that makes it 50. So here, something like this. So basically, that is that, something like that. All right. Then we compare it to how much the predator is going to suffer. So how much the predator is going to suffer is the 110. So when you do that, that is where you get your 2.2. So I can basically look at this and say that 2.2 shares is to 1 is better. But I don't want to go that tangent. I want us to go through what we are doing. All right. Then you follow suit because we need to have a share for share exchange. You know, this one you've not been given the share for share exchange. We need to find the share for share exchange because in the earlier example that you see 3 new shares for this and all those things. This one you've not been given any share for share exchange. Your question is rather asking you to find the share for share. We want you to do. So we just use our procedure. So what we have is that when they come together, this guy is together, it is 160, right? So that is that. But independently, it is 40 and 100. So there is synergy. Now, so what we are going to do is this: how to find the share for shares in the right one. So we have Laguna, right? Laguna, and Venice. So before, you see that this one, the value is 100 million, and this one is 40, right, before million in cedis. Now, with the acquisitioning happening, what you see in here is that Laguna is going to have a synergy, and the synergy that is going to happen when they come together is 20. But he's also going to incur a premium, right? The premium that he needs to incur is 25% of the 40, right? So that is a cost. Cost. We call it cost. So negative cost because you want to come together, and this one is 10, right? So which means that he has 10 million extra. All right. But this one, he wants the benefits of being at having 10 million after the acquisition so that his value must go to 50. But his value now will be what? 110. So you can strike the ratio of 110 is to 50 and get what 2.2 is to 1. So that is that. So that becomes the share for share exchange. But because share is 2.2, you have to make it a whole. So you can say 3 is to 1. That is the share for share. All right. So that is what you do. It's as simple as that. All right. So if you want the suitable share for share exchange, there you go. All right. So that is that. We pick questions and do. All right. So this is it. You can just use that, the 2.2, find the price, 4.455. All right, so this is it. The ratio should be this. All right, so if you do that on the shares of the 10 million, that is what you get, 4.55 shares to give Venice's shareholders. All right, so that is that. We've gone through the maximum amount acceptable and the minimum amount acceptable. All right, so what we need to do is to pick up a past question. See, the same thing we've been doing, nothing different. Castle and Powell, they want to merge to form Stickmark. All right, so that is that. Then they've given you the shares 40, but they've not given you the price, but they've given you annual earnings and P ratio. So you can use that to find the value of each and every. And they said that the post-merger annual earnings of the enlarged company are expected to be 8% higher than the sum of the earnings of each before they came together. So you do the earnings together, then you do 8%, so we multiply by 1.8 so that you get the new value of synergy. That's the synergy due to economies of it. So, and when they come together to their EP ratio will be, so the synergy is likely to be, you have earnings of 10 million and earnings of 5.8 million. That gives you 15.8 million. And it says that the post earnings of the merger are expected to be 8% higher than the sum. So this is it. So it means that when we multiply this by 1.08, the 0.08 is the synergy. So together, how much will it be now? So 1.08 multiplied by 15.8, which means that at the end of the day, their value will be 17.06, which means that the synergy aspect of it is the 1.26. All right, so the synergy is actually, so this is a multiplication, but if you want the synergy alone, it's 1.26. All right, so when you add, you get this. So, and they said that the combined P ratio is 9. So if we multiply our figure 17.06 by 0.6 by 9, it means the combined is 153.54. So he said explain to both for the justification of the acquisition and merger. Of course, this is theory, and you have to do the theoretical analysis by the fact that if they come together, this is what the combine is going to be. But what is the impact on the individual? Because you see, when they were together, this one is like 80, this one is like 58. So individually, it is 58 and 80. So even if you add this one without the synergy, so without the synergy, it will be what? 80 plus 58. That's like 138 individually. So when you add, but when they come together, they will have the synergy. But should each, what will be the position of acceptance or rejection of each one of them? So that is what we need to find out. Now, so we have this figure. Now, what about the shares? Already, we are told that it's been agreed that Powers will accept 3 shares in Castle for every share. Well, that means all the shares. So all that we need to do is to, so we have Castle, whose share is already 40 million shares, right? So Power will accept 3 shares in Castle for every share in himself. So if you accept 3 shares in Castle, how many shares is that going to be? So already, so it's like the share for share exchange, but you have to be very careful in reading it because it said that it has been agreed that Powers will accept 3 shares in Castle for every share. So it means that for every share in Powell, Castle is giving 3 shares. That is the meaning. So how would that be? So it's just that he's taking all the shares. So for every share in Power, so every, that is each one of them. All right. So how do you round that up? So Power has how many shares? 10 million shares. So for every share, it is going to give 3. That makes it 30 million shares. So that means that you have total of 70. When you do like we do, 0.54 divided by 70, what will you get? 153. 0.54 divided by 70. That is 2.19. So now, can you do your table to justify it like we've been doing? This is a past question. So you are likely to face this. So we have Castle shares. He had 40. New market value is by 2.19. So multiply by 40. He will get 87.74. But how much was he before all these things? It's 80. So old is 80. So he will get an increase in 7.74. Then this guy, his shares, Powell shares are replaced with 30. New price. So 30 by 2.19. That is 65.7. Old. How much was their value? 58. So it looks as if you accept it. So minus 58. That's like 7.7. So this one is positive, this one is positive. So you accept it. And by doing so, the max allocation is not there. Okay, so this one is the theory, and this one is the 10 marks. So what we've done is the 10 marks. So explain these 3 things, and also, so it's an easy way of getting 20 marks. As for acquisition and merger, it's a very easy way of getting 20 marks. And so this is CA. Easy, is very easy way of getting 20 marks. There's another question here you need to take a look at. So I will leave these past questions to you. All right. So you could see that this one, they said that The printing segment is one of the cash cow, generating 30% of its revenue, 30% of its revenue of this figure annually. They want to take advantage of the continental free trade. And so, okay, what message is this? All right. So if you go ahead to read, it says that before deciding on concentrating on everything, the company undertook an extensive retooling of its printing segment. The finance director has produced the following information. The current printer will purchase to replace the 15-year-old, which was purchased at this value, is now obsolete and will be sold for scrap. So this is kind of inflow outflow situation. Purchased 2 years ago also will have a useful life of this. In the end, get to the requirement, all right? It says that distinguish between market price and value. I mean, the price is the share price over there. And you know a value of a company, that is the net, the net asset, all right? So how much is shares trade? The value is the total. The per share gives you the market price, okay? And this one says that explain the valuation process. Describe, do you remember business valuation? Describe as subjective. Calculate the value of the printing using discounting cash flow. So all those information that we have been given here is for discounting cash flows. So get your sales, get your cost of sales, and of course, if there is a, what do we call it? Annuity perpetuity, all right, that thing we did under business valuation. All right, so you can go through that and you calculate the value of the printing segment. All right, so you get your cost of capital. And of course, the solution is given. I have the value, all right, of a worth and the market price too. All right, so that one too is determined here. Of course, the solution is given here, your revenue. You just have to pick the figures and do that. So how you do your discounted NPV, you pick out the information, you do that as easy. All right, then there are other questions for you to go through where you are doing business valuation, using discounting cash flow. And so, ladies and gentlemen, your acquisition question too, all right, they are also there. So just make sure you get the manual. Go through about 7 questions. So question 7 is there. All right, so you have the solutions also. So what are you waiting for? Thank you so much for going through this process. Acquisition and merger complete. Business valuation complete. So we are left with one last major topic to do, which is risk management. All right, so see you next time we do risk management. All right, bye-bye.